All right, guys. So this is the first day of this training. If you're just joining us for the first time, this is Electron FX Academy, and this is going to be a 30 days um intensive mentorship. And um, of course, this is going to be very beneficial for you, right? This training is going to be very tailored for the trader that is you know, serious and willing to learn, right? So it's going to be for 30 days. So if you know that you're not patient, you need to really try your best to just suck it up for the next 30 days, right? Because you're going to really, really go deep, right? So the only thing I require from you is to just whenever a video is dropped, just do what to follow, right? Don't wait until it's late. Just whenever it's 8 p.m., just come plug in when the video is on Premiere, drop your comments, like the video and share with just a friend, right? This is a free training, right? So I'm giving you my time, my effort, and my resources for free. Right? The least you can do is just to like the video and just click share. Just give to one of your friends. That's all. Just share with one friend. That's all. I'm not asking you to share with 10 people. Just share with one friend. That's all. Like the video, subscribe to the channel, and share with one friend, right? So that is basically what I just require from you. That is all I'm asking, right? You didn't ask for money, just your part to play so that these videos can reach those that it intends to help, right? So today is the first day of this training. This is day one over 30, right? So I'm going to be putting this 30 days. So this is the day one over 30. And we're going to be talking about one basic concept, right? We're going to start with two things actually. So today we'll talk about um, the concept of buy low and sell high. I want you guys to really understand this, and then we'll now talk about market structure, right? And under market structure, we'll talk about simple and advanced market structure, right? Simple and advanced structure, or let's say simple and complex structure, right? Let's put it like this. So there's a simple market structure and there's a complex market structure, right? So this is basically what we'll be treating today, right? So once again, welcome to the channel. All right. So now, this boot camp, or let's say mentorship, is going to be an answer to some of your questions. All right. Now, many people um, have asked me, what is the best way to trade? Is it with trend lines? Is it with breakout and retest? Is it with patterns and all of those stuff? Right. My answer is the best way to trade is buying low and selling high, because there are people that trade this way. For instance, now let's look at this. Like now, we have a form of support here. So the way that some people trade is that once price goes below this support, they would get involved in a sell, expecting what? A break and retest, right? They'll build something like a sell limit here. Once price break, they want the price to keep dropping, right? Now, the problem with this kind of concept is that um, the market, right? The financial market is designed by default to buy, to give buying low and selling high a better opportunity, because most times, if you notice, the market is moving in this format. If it's this how the market is always moving, right? Now, if you're a type of person that wants to be selling one price down here, you will see that you'll be actually getting a lot of losses, because um this bullish continuation is usually the larger portion of the move, right? Some people would always want to catch this kind of sales, or maybe price is breaking downwards, right? Let's say there's a kind of, something like this. And let's say there's a trend line now, right? There's a kind of trend line in the market. There's a trend line. Some people, what they do is that they wait for price to break this trend line. And then once price breaks it, they would want to do what? Get involved in a buy. They will put their buy limits here. And they'll be like, break and retest. Right. So this is the issue I have with break and retest. Break and retest does not really give you the opportunity to buy low and sell high. Because now you're buying at a high price, right? You say you are buying here. But what if price chooses to retrace lower before going up? What if price chooses maybe to come back to an order block or an imbalance down here? You can see that you have actually missed out on this golden opportunity. So you get stopped out before price, turns to the other direction, right? So that is why I believe that one of the best ways to trade is by buying low and selling high, because when you buy low, you're able to catch price at this point. If you buy low, you're catching price at this point, right? And if you sell high, you're catching price at this point. You're catching price all the way up here. So you're catching the down push. You're not, catching the move when it's about to retrace, right? So that is why I had to explain the concept of buy low and sell high, right? So one of the ways that you should trade, right? You should trade in such a way that your trade entries, right? Your trade entries are at a low price, right? Your trade entries are at a low price, right? You want your buys to be when price is at a low price, and you want your sales to be when price is at a high price, right? That's basically one of the easiest ways to make your trading simplified, right? So if you're a breakout trader, I would just like you to just consider what I'm saying, right? I'm not saying that your strategy doesn't work. I'm telling you that most often you're going to be in a situation where you'll be entering a buy when price is already exhausted from the buys and it wants to retreat, because the market has its point of exhaustion, right? So you're going to be catching trades when the market is tired of, when the market is tired of going one direction. So that's why you're not be catching your own trades, right? So this is GPUS. I'm trying to see if I can get something. All right. So that is basically one of the issues that people go through when they look at this. So now imagine that you are trying to buy this market, right? So imagine you are trying to buy this market. Maybe you saw this trend line break here, and you saw a trend line break, right? You see that maybe you are trying to buy this. As markets came back to retest the trend line, you can see that I've gotten stopped out on this, right? So those kind of trade opportunities are not very, very nice, right? It's not always nice to be trying to buy, buy breakouts, right? It's always best you buy when the price has retraced, and then you sell when the price has done what? Has made a high, right? So that is basically the concept of buy low and sell high. Now, let me bring this to your local market scenario, right? Now, the reason why we buy low and sell high is also that we understand what we call discount. Let's assume that you are a trader, right? And let's say you bought an iPhone, right? You bought an iPhone for $500, right? Now you bought the iPhone for $500, and then the price goes up to, so let's say 800, right? You can see that you bought at a low price and now the price has gone up to 800. That means whenever you sell your iPhone that you bought at 500, you have done what? You have made a gain of $300. Now, that is how this thing works. The way it works in your local market is how it works in the financial market, right? So you bought at a low price, which is what? 500, and our price goes up to 800. Now you now sell at 800, right? So you're not selling at what? 800, right? So this is it. So you're making gain because of what? You bought at a low price, right? You bought at a low price, and now you're selling at what? A high price, right? This is how the market works as well, right? So you make profit when you buy and price is what? Going up. So that's why you want to always be buying at a low price, because you want price to go up and up in your favor, right? And the reverse is the case for a sell, right? Let's assume that maybe you are told that that this iPhone now, maybe you are told that this iPhone is going to drop next month, and then you now sold all your iPhones for what? You sold it at what? 500, right? You sold all your iPhones for what? 500, because you heard that price is going to go down next week. And then what happened? Price now drops to what? 200. So you're not buying back at 200, right? So you sold your iPhones at 500. Now you're not buying back at 200. You can say you have made profit because you sold your iPhones at a high price. And now you're not using the gain to buy at lower prices. So if you sold your iPhone at 500 and then you hear that price drop next week, you say you're in gain because you sold at a high price. And now you cannot use that gain you made to buy at lower prices, right? Maybe you want to restock your shop. You cannot buy at lower prices. Meanwhile, you sold at a high price. That is profit for you, right? That is how the market works. That is why you should always try to buy less. So the same logic in your local market, by the logic of buying price when it's low and selling when the price is high, right? So now that brings us to the second point. So I think we are done with the first topic, which is what market structure. We are done with. If we're done with this, so we're heading over to what the next thing, which is what market structure. Now we already know what market structure is, right? It simply means the candle formation. So basically, we have three kinds of market structure. We have when the market is bullish. This is not new to many of you. We have when the market is bearish, and we have when the market is what in a range or consolidation, right? So you can call this range or consolidation, right? So it's still the same thing when the market is in a range, right? So typically we know what this means. So in a bullish market is characterized by what we call higher highs and higher lows. So this is what makes up a bullish market: a higher high and what a higher low. This is what makes up the bullish market. Now, what do I mean by higher high and a higher low? Now, if the market is bullish, we want to see price make what? Look like this. So now, this, we already know all this now. You know what all this are. You know that this is called a higher high, and this is what they call a higher low. The lows are what they call higher low. And now, why are they called higher lows? Because this low is higher than the previous low, right? That's why we call it higher low. A low that is higher than the previous low. Then this is a higher high because this high is higher than what? This previous high. So we saw this high is higher than the previous high. So higher high. This low is higher than the previous low. So higher low, right? That is why we call it that. Now, this is what makes up a bullish market. You want to see price making new highs and failing to break new lows. So pay attention to this. For a bullish market to continue, price, take note of this, take note. If you have your notepad or you have your pen and book, just take note of this. For a bullish market to continue, right? For a bullish market to continue, you must see price make new highs and fail to make and fail to make lower lows, right? So what do I mean? For a bullish market to continue, you want to see price able to do what? To break high and make a new high. And then you want to see price fail to do what? Make a low that is lower than the previous low. That means this is a higher low. Why? Because it is above the previous low. But if this low goes below the previous low, it becomes what? A lower low, right? Automatically it becomes what? A lower low. So now you do not want price to do this, because doing this means that we might be seeing bearishness. All right. So we want price to fail to do that and continue to make what we call higher lows. That is the only condition for a bullish market to continue, right? So if a bullish market continues, that means these two things are in place. All right. Now, for a bearish market, we characterize that by what? Seeing what? Lower lows and lower highs. So for a bearish market is characterized by lower highs and lower lows, right? For a bearish market, it is characterized by seeing what? Lower highs and what? Lower lows, right? That is what we see in a bearish market. Now, what do we mean by lower highs and lower lows? Now, the same analogy I gave earlier is what I will still give you guys again. So watch this. Are you seeing what I'm saying? So now we have what? This is a lower high, right? And my God, this teaching is getting very, very exciting. If you're enjoying this training, just drop some fire, because this 30 days teaching, I want to take my time. I'm not rushing, right? I'm taking my time to give you value, right? I'm not going to be hurrying. I'm not in a hurry. In fact, my private mentorship has been paused. Because of this training, I've paused every kind of private mentorship. It's just YouTube, just this training. I want to just make sure that I give my community the best, in this training. So this is going to be the one stop to your trading challenges, right? Right. So this is going to be your one stop to everything you're looking for, right? Everything you're looking for will be found in here, right? So that's why I'm taking my time. I don't want to rush. I just want to take it this step by step, step by step, step by step. And if you're getting value, just drop value, 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 value. This is how I know that you're watching this video. Just drop value, value, value if you're getting something from this teaching. All right. So now, why is it called a lower high? It's called a lower high because this high is lower than what the previous high, right? It's called a lower low because this low is lower than what the previous low. So that is what makes it lower high and lower low. That is what makes up what a bearish market, right? Now, what is the next thing? Now, for a bearish market to continue or to continue being, for a market to continue being bearish, what do we want to see? We want to see the market do what? Make new lows and remember, fail to make higher high. So now, we want to see the market make new lows and then fail to make higher highs. What do I mean? Now, this low is below this previous low. That means we want to see price make a new low, make a new low, and make a new low. But we don't want to see price go above this high. Remember what I told you that once a high is above, now remember what I told you. If price goes above this high, that means it is now what a higher high because it's above the previous high. So we want to see price continue in this format where price does not make a new high, it continues going like this. So we want to see price continue to make new lower highs, right? Sorry. Once the price continue to do this, lower high, low, this is what we want to see in the market. We don't want to see price make a new high. All right. So that is what makes a bearish market bearish, right? So take note of that. If possible, take your pen and book and then make annotations or drawings of this. Take screenshots so that you don't forget this, right? So that is all for bearish market. Now let us look at the last kind of market we have, which is what we call the range or consolidation, right? So let's look at the range or consolidation. Now, this is typically a kind of market that is in a kind of box. So the market is typically moving in this fashion. So you have the market in a kind of box. So the market is like doing something like this, right? It will go up, come down. So this is what basically we see in a bearish market. The market does not really have a particular direction. That means overall, right, this market is not going up, it's not going down. It's just in a sideway movement. Like the market is moving in a side. It's not going up, it's not going down. It's not bullish, it's not bearish. It's just up, down, left, right, just in a range, up and down. Now, one thing about range is that inside the range, we can see a bullish market inside the range, right? We cannot see a bearish market inside the range. So it happens where you can see this trend inside the range. That means, for instance, now, if this range is on, let's say, a weekly time frame, maybe this range happens on a weekly time frame, right? Believe me that from this point, from here, if we're in a weekly time frame, from this point to this point, what will we see? We're going to see what? A bullish market, right? So between these 2 points, what are we going to see there? We're going to see what? A bullish market. So the trick about range is that you have to look at the time frame it occurs. So if it's in a higher time frame, if it's in a higher time frame like a weekly chart, you can see a bullish market inside that weekly range, right? Now, between this point here and this low, what are you going to likely see there? You likely see what? A bearish market. So whenever you see a range, right, you look at the time frame where it is showing. So if it's on a higher time frame, you cannot go to a lower time frame and look for what? Opportunities within that range. So you mark the higher point of the range and the lower point of the range, and then you look for what? Opportunities. And of course, one of the easiest way to trade ranges is by doing what? Is by dividing this into two. So you divide it into two. So you have the midpoint of the range, and then you sell, the cells are more likely to hold in the upper part of the range. So your sell will likely hold at the upper part of this range, while your buys will likely hold at what? The lower part of the range. So for your cells, always look at the upper part of the range, while you look for buys at the lower part of the range. Now, this is only the case if the range is on a higher time frame, right? This you only do this when the range is on what? Is on a higher time frame, right? If this range is on 15 minutes chart, you do what? You stay out. If this range is on 1 hour, you stay out. All right, always pay attention to what? The distance of the range. Let's say pay attention to the height of the range. How far is the range, right? So the height of the range is what you pay attention to. So the height of the range is what you pay attention to. Height simply means from the upper part to the lower part. How far is the distance between this and that? So if it's very wide, then you can look for opportunities in the range. But if it's a very narrow range, maybe the range is very tight like this. Let's say it's a very tight range, something like very tight, like something like this, very tight range. This kind of market can get you injured or make you to lose money. This kind of tight range like this. So the best thing to do in this kind of range is what? Is to stay out of the markets. This kind of range, you stay out. That's what you do. You don't negotiate. In this kind of market, you stay out of the range when it is very tight and consolidating, right? So when the market is in a expanding range like this, you can see some expansions there. You can then look for buys and sells in between the range. So look for buys when the market is at the lower part, and then look for ones at what? At the higher part, which is what? The upper 50%, right? And then of course you have to look for what? Structural what? Confirmations. So if you understood this, I just said, just type value, 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 value. That's all we are typing in this. Anytime something makes sense to you, just type value. That should be a reflex action for this next 30 days. Whenever you watch something, it makes sense, just type value. That is it. That is the only keyword we want, value. Or you can type make sense. Or let's not make it let's not make it like a bot. Let's make it spontaneous, right? I got value. This makes sense. This is valuable. Just make it make sense, right? I don't look like we're using bots to comment, right? So that is basically how we look at the market from these three angles. So quickly, I'm going to show you guys this with ray charts, right? So now, of course, you can see, let me zoom out, or let me go to a high time frame, right? So this is a market now. Let's look at this, right? So let's pay attention to this market. So what can you see here? Bullish market, right? So you can see what? Higher high. Let me hide my drawing. Oh my God, I can't hide it. So what do you have here? Sorry, this is your higher high, and this is your higher low. So can you see how these things occur? So can you see that? So this is what is occurring, higher high and higher low. So can you see? See another higher high here. See another higher low here. Can you see how this is happening? See another higher high here. See another higher low here. I see how this is occurring. Can you see this is an example of it? Right? So let's look at an example of what? A bearish market. So I wish I would see something there on bearish. This market has been, going one side for a long time now. All right, let's see if I can see something that, okay, I've seen it. So this is a bearish market now. What do you see here? Lower high. And then look at this low here. Lower low. All right. So this is what has been happening on this market, right? It has been happening on repeat. I see another one here, lower high. What do I have here? Someone might be asking, why am I not picking everywhere? I'm not picking the obvious one, right? There's no specific reason. I'm selecting some lows to pick, right? Okay, let's also use this. Okay, let's use this one. Look at that one here. So can you see how this is occur? Can you see it? Sorry. So you can see it. So this example. So your assignment is going to be what? To look for a range. Look for a range and look for a range. Share it into two and then tag me on Twitter. Right. So if once you find a range, just say this is a range based on the assignment given and then tag me on Twitter. Right. I'm going to be paying attention to this kind of assignment because This assignment will let me know that you watch the videos, and I have some gift for those guys that will be very consistent with it. So look for a range. I've shown you guys bearish and bullish. So you look for a range and show me markets with what I taught you. All right. So let's leave that. So now let's talk about what we call complex market structure. So I will not be able to exhaust this one today, right? I'll just kind of touch a bit on it so that you guys will not be left out. So let us touch. We're not going to go deep in it. So let us talk a bit about complex structure. Now, in the complex structure, we are abiding by four rules. Now, the first rule is that a valid higher, let's say, a protected, or let's say, let's make it this way: a protected protects, a protected low must take liquidity and make a new high. I will explain this to you. Don't worry. Just write it down. These are the two rules for complex structure. Now, a protected high must take liquidity and make a new low. All right, so now these are the two things I want you guys to note. Now, these two instances are for two distinct scenarios, right? Now, this first scenario occurs when the market, this is too small. This first scenario occurs when the market is what? Bearish. Sorry, when the market is bullish. Right? I will explain. Don't worry, just follow me. I told you I will explain everything. I told you guys that I will explain everything. Don't be in a hurry. If it's confusing, just give me time, right? Don't feel uncomfortable. Just give me time, please, to break it down for you. Don't worry. Just take your time. I don't feel I'm not rushing, and I'm taking it very slowly. Don't worry. If it's going over your head, just take a deep breath and just follow me. Follow me. Okay. Now, when the market is bearish, for you to classify your protected high, it must take liquidity and making it. Now, what do I mean? That means when the market is bearish, it must do this. Okay. Now, this is what we refer to as what? A protected high. Why is it protected? Because it took out liquidity, this previous high, and then what? It made what? A new low. So where's the previous low here? So it went below this low. So it took this liquidity, which is what the previous high. So in this example, for today, just for today, liquidity is previous high and low, right? No, just for today, right? There's more than this. So note, it is more than this. Liquidity is more than this, but for today, liquidity was previous low and previous high, just for today, right? Just for today. Because when we start talking about liquidity, you see that it's more than this. But just for today, previous low and previous high, that's all for today. Now, for a low to be protected, it has to, now for the bullish example, we have to sit back and do what? Take out what? A previous low and then make what? A new high. This is what makes it a protected low. So now at this point here, we have what we call your range high, or let's say your P high, protected high. So you have your P high. And then for this, we have our P low. Let us say P low. I said P low. So your protected low is this one. Because why? It took our liquidity and then what? It made a new high. So now, in situations where price take liquidity, now imagine that price took our liquidity now and could not make a new low. Is that protected? No, because there are two conditions. You can see that there's an and here. It must take out liquidity and make a new high. So these two conditions must be fulfilled. for it to be protected. So if maybe it takes liquidity and did not make a new low, that is not protected high. If it doesn't take a liquidity and it makes a new low, that's not a P high because there are two conditions to it. In fact, three conditions. Number one, bearish, take out liquidity and make new low. Bullish, take out liquidity and make a new high. So there are even three. You must understand the trend in which you're in. So that's how we got protected low and protected highs. So just take note of this, right? This is where we'll be continuing tomorrow, because tomorrow we're talking about break of structure, change of character, and those things will make sense when you understand protected lows and protected highs. So just allow me to confuse you for today with this. Tomorrow I will explain better. So, but for today, I want you guys to do just two assignments. Number one, locate a range, like I told you. Number one, locate a range. And then number two, locate a protected high and a protected low. Just tag me on Twitter. If you see it, just tag me on Twitter. Post the screenshot and then tag me on Twitter. That is all. Just show me the range and then show me a protected high and a protected low. Then I will catch you up tomorrow to explain deeper about this, and then we'll talk about break of structure. So if you just like this video already, please like it. If you have not subscribed, please subscribe. If you have not shared, please click share and then share the friend. And of course, to help this video to reach out more people, you have to drop a comment. So drop a comment so that this video can spread, because the more you drop comments, the more Twitter will see, the more YouTube will believe that this is a valuable post or valuable video. So just help me by posting. I'm not asking for money. All you just do is to like, share, comment. That is all. We're not asking you to send any money. Just do those three things, which are free of charge and can take you less than 1 minute, right? And of course, subscribe to the channel so you can be notified when our next video is coming on. So see you guys tomorrow. Have a wonderful day. I love you guys, and